Hi there, it's Lindsay Smith from Keller Williams. Thanks for tuning in to another segment of my Friday morning coffee. This is my weekly opportunity to share with you some of the things that I've learned within real estate within the last week, market trends, just anything that's happening within our local real estate community in Whitby, Oshawa, and Clarington. I was fortunate enough to go to a CMHC market outlook for 2013 last week. Now CMHC is it's the Canada Mortgage and Housing Corporation. It's a federal entity, and what they do is they insure the mortgages in Canada. They also do all the statistical information, and they do the trending to see where real estate's going. So it was a really informative session. And what they had said is, the gal had said they anticipate 2013 to mirror 2011 in far as how the market's going to move. Now 2011, I went on to Market Watch, which is the Toronto Real Estate Board's trade paper. I went to the end of 2011 and said, well, what did they say about the year? And they said that it was the second best year for sales in the MLS recorded history. Low inventory, low mortgage rates meant substantial competition for buyers when a property came on the market, and that added increased pressure to prices rising. So what they were saying is 2011 could be summed up: low inventory of homes for sale, so not that much for sale. Lots of buyers out there buying. When a good property hit the market, a lot of times they got into competition and the prices were driven upwards. So if you look at who's buying real estate? I guess that's one of the questions that they kind of raised. And if you look at it, one of the slides they showed was comparing the MLS average price to the growth in stock market since 2000. So from 2010 to 2000 to 2010, they looked at what had both gone up and increased in value. And the real estate market has totally outperformed the stock market, absolutely over the top. There was one period from 2006 to 2009 where the stock market, it mirrored the increase that the MLS prices had, but then it fell off. We all know what's happened since 2009. The stocks have dropped through the floor. And the other thing too is, if you bought a house or a stock in 2000, here we are now, 2012, the end of 2012, whatever the value of the both of those going up, your house is tax-free, so there's a huge benefit there. So they went on to say who's buying these houses, and they identified three different age groups: 25 to 44, 45 to 65, and 65 to 75. And each of those three groups are doing different things with real estate. So they looked at the 25 to 45, say, that is the largest group of people out there. However, it's not growing in size. Since 2006 to 2011, so in a 5-year period, it only grew by 2%. So it's kind of a stagnant group there. They make about $85,000 a year on average, family income. Typically, they can be described as carrying lots of student debt. They're starting young families, and it's the age range that has the highest unemployment. So they're a little bit challenged. Now, if you look at the 45 to 65-year-old group, it's almost exactly the same amount of people in that group that the 25 to 45-year-old group is. However, average income, $105,000 family income. They tend to be more settled in their careers. Their families are already in place, and they've got more money. They have more disposable income. They've got higher household debt, but it's debt that they're managing. So they're the ones on the lower end, the 45-year-old range. They're the ones that are moving up, buying bigger houses, really getting into those executive homes. The ones on the 65-year-old range, 60 to 65, they may be buying down, taking some equity and helping their kids with university. That group has grown dramatically in the same period. From 2006 to 2011, it's grown by 19%. That's the largest growing group that we've got, and they're also the ones that are buying real estate. 65 to 75, not a huge group. It's about a quarter of the other two groups. However, it grew by 16% as well. Very interesting. Those people there typically can be described as, if I looked at them as a group, a lot of those people are selling their houses and moving into rental apartments. So they're getting out of the market. So really it's the 45 to 75-year-old range that's really kind of controlling the market. The 65 to 75-year-olds are the ones producing the listing inventory. So are the 45 to 65-year-olds, and the 25 to 45-year-olds are the ones that are really buying in. So if you look at 2013, looks like we're going to have an excellent year. It looks like we're going to have low inventory again of homes for sale. What that means is that it doesn't guarantee that a house is going to sell just like that in multiples. But a good example was I just sold a house recently for $385,000. We broke the area record for the highest sale price. In that same area, there's a couple of more common houses, common meaning just more average homes for the area, in the 320 range, and they're sitting there doing nothing. So it's going to be spotty. So what I would suggest you do is on my website there's something called the Red Book, and the Red Book is something I've put together on how to make your house look the best to get the best amount of money back for it. It's kind of like a staging book that you can work through on your own. You can find it on there. It's right on the front page. If there's anything else I can do for you, give me a call, shoot me an email. I'd be more than happy to sit down and have a chat with you. Hope this is of value. Have a great day.